everyone. This is Krista Yankee with the Kresge Foundation. Thank you so much for joining us today to talk about opportunity zones, specifically how the Kresge Foundation has been working to approach those. Your phones are going to be on mute for the duration of this call today, but we will be doing questions at the end of our session. You can use the Q&A tab at the bottom of your screen on Ring Central to enter in questions. You can put those in at any point of the webinar, and we will save time at the end to get to those. We're also going to be recording the webinar today. We will share a recording of the webinar out via email to everyone who registered, and we will also be posting it on our YouTube, on the Kresge Foundation's YouTube page. If you have questions throughout, one request we would make is that you please try to keep your questions at a high level. We won't be able to go into particularities around specific investment projects or that type of thing. So as you're thinking about whatever questions you might have, if you can try to frame them in a way that will be relevant to a greater audience, that would be helpful. And there's also a poll that you can take I think it should be at the top of your screen, that we would love to just know who we have in the room with us today. So if you can take the poll, it just has a few options about what sectors we have, and so we'd love to know who we have with us. Agenda is here on the screen, and our speakers are here on the screen. Joining us today, we have David Sand, who's the Chief Impact Strategist with Community Capital Management. We have Jonathan Towers, who's the Managing Partner of Arctaris Impact. And we have Kimberlee Cornett, who's the Managing Director here of the Social Investment Practice at the Kresge Foundation. And we have Aaron Seybert, who's the Social Investment Officer on our Social Investment Practice. We're going to quickly go through just a little background on the foundation. Then we'll talk about our work on opportunity zones, a little bit of the path to get us to where we are now, which is having made $22 million guarantee commitments to these two firms that we have with us. Then each firm will detail their opportunity zone work, the kind of funds and the kinds of investments that they're planning, and then we will take time for the Q&A. And with that, I am going to turn it over to Kimberlee Cornett to just give a bit of background on who we are at Kresge.
Good afternoon, everyone, and thank you for joining us and your interest in this webinar. As many of you may know, Kresge is a $3.5 billion national foundation that is based outside of Detroit, Michigan. The foundation has 6 individual program areas, but the overarching goal of the foundation is to increase opportunity for low-income citizens living in America's cities. And as a foundation that is largely oriented to community development, we have a very keen interest in seeing the Opportunity Zone initiative realize its goals of lasting economic development and job creation in underinvested communities. As Krista mentioned, I lead the Foundation's social investment practice, and through the Foundation's $350 million impact investing commitment, we use debt, equity, and loan guarantees to accelerate progress around the Foundation's programmatic strategies. But this year, as the Oz effort has been rolled out, we have looked for opportunities to put our investment tools and specifically our allocation of unfunded guarantees to work. But to step back, we see opportunity zones as a really creative experiment to use the tax code to drive new capital into communities, and we applaud that effort. But fundamentally, we believe that good community development programs require transparency and accountability to the social impact that they are intended to achieve. And metrics are needed to evaluate how efficiently and effectively public programs are realizing that. And information is needed to inform the public evaluation of whether a policy proposal is working. And right now, several things are absent in the existing Oz legislation, although we certainly hope that in the future there will be improvements. But because the program doesn't currently include those social impact metrics or transparency, we have taken steps to create an investment initiative that tries to create those and inform the space as it evolves. Some of you may know that last summer, the Kresge Foundation and the Rockefeller Foundation opened a call for letters of inquiry from prospective Oz managers who had experience working in low-income communities, were committed to or shared our priorities around long-term impact and financial reporting, had experience raising capital from the kind of investors that we think are going to be attracted to this benefit, and could share risk alongside of the foundation. On Friday before the deadline, we had about 17 LOIs, and Monday at 5, we had close to 150. So we were astounded at both the response to our LOI, but also to the obvious activity that Oz was spurring in communities really across the country. Since that very strong response, the foundation has consummated agreements with Community Capital Management and Arctaris that we're going to tell you more about today. And I want to thank both of those firms, for their leadership and their willingness to partner with us. And I also wanted to specifically thank my colleague, Seybert, who really has led our efforts. And so without further ado, I will we'll get to the heart of the matter.
So this is Aaron, and thanks everybody for joining. I'm going to be very brief because I want to give time for our managers to talk. For Kresge, it really highlighted that we are concerned about the transparency and accountability and the data evaluation that's going to be necessary to evaluate this. So the two fund managers that we selected are really proof points around how this burgeoning industry, this emerging market could operate, right? Market norms can be established where investors expect and managers deliver a level of transparency, reporting and accountability that is useful. So I'm sorry, it sounds like my audio is hard to hear. Hopefully this is better. So the proof points, we're trying to drive for is to set some market norms around transparency, reporting, and accountability. And we're hoping that these managers, because of their national scale, because of their name recognition and their ability to raise substantial amounts of capital, that they'll be able to provide those proof points. I think what we find useful, particularly for philanthropic organizations or socially motivated organizations who are looking for a place in this emerging market, that a trade can be made, right, to incentivize managers and their investors to agree to these covenants by de-risking or putting them in a better position from a risk-return perspective relative to the market, and that that trade that can be made with covenants is a useful market mechanism, particularly early in the market. These managers had a depth of experience that was necessary to be taken serious in the market. Both are well-established firms. They're big enough to raise capital from the kinds of investors and institutions that we want to target, which is namely high net worth and ultra high net worth individuals, and then institutional capital, we think ultimately from banks or from wealth management platforms. So those are, could go to the next bullet. I think the last thing we want to know that we're not going to do additional funds at this time. Kresge in its capacity as a philanthropic partner, we're limited on resource allocation. So the proof points are the two funds that we are working with now. We have a separate effort for smaller, high impact funds in an incubator set up that we could probably address at another time. But we do think that there is a role for other national foundations or other socially motivated organizations to do something similar to what we're doing. And we think that this is a bit of a template and are certainly looking for partners. I'll just highlight some work that we've been doing around a guarantee bank nationally to try to use foundation balance sheets to take on risk similar to what we're doing here in the opportunity zone space. So I think we can go next slide. So quickly, as we said, it's an unfunded guarantee. We're going to take our first loss position that will look different between these two funds. Arctaris, which Jonathan will talk about, is really focused on what we consider to be traditional private equity space, investing in operating businesses who need growth equity, repositioning in the marketplace. They will hold portfolio companies, and our guarantee will step in between the fund investors and the underlying portfolio companies to shield those investors from losses on the underlying portfolio companies up to a maximum amount of 15 million, and with some return to the foundation at the back end, once the fund is specific targets. For community capital management, while they'll also invest in operating businesses, our work is mostly focused on their real estate exposure. And so our guarantee up to 7 million will protect investments at the project level. Both will be initially a 10-year term, and we also hope that the Kresge brand will provide a couple benefits to these managers. First, in that we hope that our name brings a certain level of legitimacy in the impact space, and that investors who are looking for funds that are socially aligned and can be considered responsible in the marketplace will benefit from the Kresge name. Also, we have had a significant amount of interest from outside partners, investors, and other philanthropic organizations who are looking for a path in, and we're hoping that the Kresge brand will sort of provide that pathway into the space. So a couple things that we'll just highlight, and maybe you may recognize these covenants from what was built into the New Markets Tax Credit Program. Would be each fund manager will panel a non-governing advisory board to effectively deliberate and provide advice around the impacts of the investments that are made at the sort of portfolio level. The advisory board will have some low-income representation. We think, give an outside view into the operations of each of the fund managers. The fund is going to identify itself and its marketing materials as an opportunity fund and allow investors, I think we dropped a word there, but allow investors to participate in the federal incentive while the fund itself will be publicly known. And as we said, in the transparency space, we think one of the issues really is that local communities may never know, will likely never know what funds invest in their communities, where the capital is raised from, what it was invested into, because there's no transparency. And so we think self-identification of funds that provide clarity on their investment thesis is necessary in the market. And then we want a partnership, right? So we are focused on trying to proliferate these kind of hard covenants into funds because we think they provide a good, the best bet that we have at the moment to protect against some of the things that we're most concerned about, but also provide a path for market participants to use the incentive in a way that is likely to yield both economic and social benefits. I think we'll just highlight quickly on those were covenants at the fund level. At the project level, some of the covenants that we're proposing, particularly where housing is concerned, which is a big hot topic in the space, having some requirements around AMI targeting and providing some, workforce to low-income housing targets, while still understanding that the fund needs to generate a competitive return. What an anti-displacement strategy is, we're not going to dictate down because it's highly contextual, but we think that the funds need to practice an anti-displacement strategy. And then we're going to have some, covenants around or some restrictions on economic development targets, particularly that's around job creation and quality of those jobs. I think one of the things we all need to be very concerned about is the greenwashing of this incentive. And so making really clear about what the actual net benefits to the communities where the capital invested is, particularly around job creation, this is pretty important. On the operating business side, this is really around the quality of jobs targeting. I think we've got a lot of interest from communities across the country where wage growth is really an issue. So we think that because a lot of the justification for this incentive is really around economic mobility, that wage growth was pretty important, and so living wage jobs was targeted. And then we want to prevent against the sin businesses, which again ties back to the New Markets covenants around the things that we just think from a social perspective we ought not to be subsidizing from the public sector. Okay, I think next slide. Okay, so I think at this point, maybe what we'll do is just turn over to Jonathan. If you're ready, Jonathan.
What he's supposed to do is turn over.
Jonathan, are you there? Maybe he's on mute. I'll tell you what, Krista, until we get
sorry.
Jonathan,
Jonathan, we're having a issue with Jonathan's audio, so we'll come back to Jonathan, and if David could maybe go through CCM's fund. I'll move to that slide.
Sure, happy to do that. Hello, and thank you all for being here. Community Capital Management is a impact money manager. We're 20 years old. We're based in Florida. I work in our Boston office. We manage about $2.5 billion of all impact assets, all in the United States. When the Opportunity Zone program came out, we had some skepticism. I think it was a healthy skepticism in terms of some of the things that Aaron and Kimberlee have already mentioned. But we decided almost exactly a year ago, I think it was June of last year, after the specific Opportunity Zone census tracts designations were made by the 50 state governors and approved by Treasury, they matched up very well with communities and markets that we're familiar with. In fact, because we geotag every investment we make and every investment that we have ever made, we were able to look at the 8,000 plus or minus Opportunity Zone census tracts and found that as a firm, we had a cumulative investment in these neighborhoods in excess of $900 million. Now, they weren't Opportunity Zone communities when we placed money in them. Program didn't exist. They were underserved communities, and that's kind of what we're set up as a firm to address. Also, the product type and investment type was different. We had historically invested primarily debt, and as I think probably most of you know, the Opportunity Zone program calls primarily for equity. But it told us we had the capacity and the delivery capability that you would need to have for a national Opportunity Zone fund. So as the slide says, we invest in 18 impact themes. It's taken us 20 years to develop those. We're going to use those same themes for our Opportunity Zone fund. I invite you to go to our website, but some of the ones that are particularly relevant for some of the issues we've already talked about today are affordable housing and sustainability, job creation, addressing income inequality, transit-oriented development, things like that. So we will be investing in Opportunity Zone opportunities, and it's frustrating you have to say that word in different contexts, but we're looking to address and respond to the same themes in this new fund that we've been doing in our existing business. And so because of the firm and our clients' insistence that we have a commitment to transparency and to granular reporting of impact metrics, the covenants and requirements, some of which Aaron mentioned, that were in the Kresge Rockefeller LOI, matched up very well with the work that we've already done to date. And so in setting up the fund, it's going to be a national fund with a multi-asset approach. We're going to invest in qualified Opportunity Zone businesses. And our definition of diversification means diversified by geography, by type of business, and by impact theme addressed by the investment that we made. We're not going to invest in startups, but rather in businesses, nonprofits, and entrepreneurs who have a track record and a commitment to impact and the ability to scale their work in other Opportunity Zone markets. And now that the circle is populated, some of the things that we're already looking at include some food systems investments in sustainable agriculture, some affordable housing that's mixed with an arts and culture gallery space. And we're working hard at finishing the legal work that's required to set one of these funds up, and then doing both the the fundraise and also the investment implementation. And I'm happy now to turn it over to Jonathan from Arctaris.
Great. Thank you, David. Hopefully the audio is working now. Can you guys hear me?
Yes.
Okay, great. Krista, let's start on the fund facts first, and then I can go into this chart second here, actually. But, great. So just by way of background, co-founded Arctaris 10 years ago. We're currently investing out of our fourth impact fund. It launched last year. Our investments focus on companies located in low-income areas throughout the country. They always have. So in a certain sense, we've been investing in opportunity zones from day one, but obviously see the new tax incentive here from IIOA as being a great tool and an enabler to attract capital from groups who might not otherwise have been interested in investing in these types of companies and projects into those areas. So we're thrilled to be working with Kresge. Thank you for the opportunity to work together, and thank you for organizing this webinar. Just a little background on Arctaris. Based in Boston, we've partnered historically with numerous commercial banks. This is a CRA investment. We have also partnered, we did a Michigan fund with State of Michigan and U.S. Treasury Department. We've partnered with numerous foundations as well. Our investors are generally market rate minded investors. They might be banks, they might be insurance companies or funds of funds, family offices, but they are looking for market rate returns. And this blended financing fund structure, which incorporates things like the Kresge Guarantee or first loss capital, they become the key to unlocking these other sources of capital. By de-risking the funds, it reduces the risk premium on the fund overall and makes these impact investment funds attractive to, like I said before, investors who might not otherwise have been looking to invest in places like Detroit or Flint or rural Maine. So we are expecting additional guarantee commitments from other states and foundations. When we get to the next slide, I'll talk about how this is really working, because it is an interesting case study in development that is showing how catalytic Kresge's leadership in this area has actually been. What will the fund invest in? 70% of our capital will go into traditional private equity businesses with an eye towards creation of living wage jobs. This might look like acquisition of a manufacturing company. Maybe it's already in an opportunity zone. Maybe we're moving it into an opportunity zone, and then providing that company with growth capital to achieve organic revenue growth as well as make acquisitions. A lot of our companies are manufacturing and industrial. We're also active in alternative energy, telecom, and adding on industrial parks as well. When you look over in the bubble here on the right, we've broadly defined this area, the other 30% of where this fund will go, as real estate infrastructure. What this really looks like in practice are municipal large-scale solar farms, doing 300 miles of broadband in an area that's not currently covered, municipal public works and industrial parks. There's been a great amount of talk in opportunity zone circles about the long-term cap gain benefits associated with this program, but very little recognition given to the ordinary income side of the equation. As those of you who enjoy taxes like I do have seen, in any depreciating asset, there is a tax deduction that an investor and an owner of a property or a solar farm gets each year. The asset depreciates down, and then if you sell it, you can get kicked on the way out the door with a depreciation recapture. If you sell, say, a solar farm, it depreciates fully in 5 years. If you sell it for $1 million in the 6th year, you will be taxed on $1 million of ordinary income. the reason that opportunity zones are uniquely suited for these types of infrastructure projects is because if these funds are structured properly, you can avoid the depreciation recapture and then serve a purpose that goes far above and beyond simply the long-term cap gain benefits. So, like I said, rural broadband, things like this, buildings for municipalities, buildings for schools, industrial parks where very likely many of our manufacturing companies will go. These are the types of assets that we really want to hold, and they're an important part of the community development equation. Krista, if we could flip back to the other chart, I just wanted to explain what's really thank you. What's really going on here? So this started with a Kresge Foundation guarantee that's $15 million. As I said before, we're looking to match that 10-to-1. So we would expect, or we expected initially, that for $15 million of guarantee, we would be able to raise $150 million of traditional equity capital. And I would say that that's a good conservative projection at this point, and we may be able to do better than that. But I think the more exciting piece of this story is the growth horizontally on the horizontal axis, where Kresge's guarantee has already been followed by one other state, which is providing a $10 million guarantee for qualified projects in its jurisdiction area. And quite a few other foundations, states, and cities are looking at supplementing this further. We're still in the middle of this process, but if I had to guess, this winds up looking like $75 million in total target guarantees. This would be guarantees like Kresge's, which is an insurance-like form of product, and then also first loss capital, which is kind of like what we did with State of Michigan with U.S. Treasury SSBCI funding previously, where the philanthropic or government investor becomes a junior equity capital investor. With $75 million in total target guarantees, in theory, we could raise 10-to-1 LP capital on top of that, and this turns into a $750 million fund. I don't know that these numbers are exact. We're really using these as representative examples just to show how one foundation was able to plant a stake in the ground and then say, okay, other foundations can bolt in to this program or add their own guarantees on top of it. And you're not just getting multiplicative leverage, you're really getting exponential leverage off of an initial program-related investment from a foundation. So I think this is an exciting case study in formation, and look forward to sharing updates on how it goes as we actually get into the thick of the fundraising process, but early signs are very, very positive.
And now you have to click back on so I can keep moving. Click back on my screen. Okay. All right. Thank you guys for that overview. We are going to be moving now into questions, and there's been a few that have come in already, but if anyone else would like to start typing their questions, we'll be taking as many of those as we can for the next 30 minutes. In the meantime, we just wanted to share a few ways you can stay connected with us. One is to subscribe at kresge.org/subscribe. You can subscribe there for our weekly newsletter that goes out where we share news from across our foundation. The social investment team is on Twitter at KresgeSocInv. And then you can see these 3 email addresses here to reach out to either any of the organizations involved. And with that, I will go to questions. Again, you can type your questions into the questions tab. And our first question is about what is the size of the investments that each manager will be targeting to make? So maybe David, if you want to go first.
Sure. So Community Capital Management is targeting a $300 million raise for the National Opportunity Zone Fund that we've been talking about today.
And then I think the question is about the size of
Sorry, the business investments. So if we have a $300 million fund, our hope would be to make a dozen plus or minus separate and distinct investments in qualified opportunity zone businesses.
Okay, great. And Jonathan?
Yeah, our investments will generally range between $10 and $50 million. And within that, keep in mind that we are talking about platform acquisition strategy. So we might buy a company for $20 million and use that as a platform, buy companies for $3 million or $5 million that are outside of the opportunity zone. And these are asset purchase agreements, but we would purchase the assets and move the jobs into the opportunity zone. So there's a great M&A synergy case in buying up little companies and consolidating them in areas that desperately need jobs. So 10 to 50 is our range, and the target fund raise is 500.
Okay, great. And that was going a little bit in and out for me, but I think overall you said $10 to $50 million per project and
correct,
$500 million raise overall. Okay,
that's right.
Next question, there's kind of a general question that's come in about how particular investment opportunities could make themselves known to the funds. I think generally right now, if because of the volume of those kinds of emails and calls that are coming in, we would say if you do have like an executive summary that you think aligns with the funds, then I'll keep the screen up with the email boxes, because you could send your executive summary directly to the funds, in particular to Kresge, although at this time, Kresge is not planning any future investments and can't really serve the role as a broker. But if you think something would be interesting to us, you could send an executive summary our way as well. So I don't know if anyone else wants to add to that. Otherwise, I can go to the next question. If someone could give an example of the anti-displacement strategy that might be included in a project covenant.
Sure.
I can try. Go ahead. After you.
No. I'll fill in if anything's left over.
Okay. So I give an example of some things that we have seen, which, as I said, I think that this kind of covenant is highly contextual, but some of the national funds that we have seen, or people who are thinking about this are thinking that they may say the fund proceeds can't be used to acquire expiring low-income tax credits unless there is a re-syndication or other preservation effort, that any existing housing that is acquired that is naturally occurring wouldn't include units above, more than 50% of the units, greater than 80% AMI or 120% AMI, depending on what the depending on the marketplace that they're in, or simply stating that investments made by the fund will align with local housing strategies as identified by the municipality. And I think there's a bunch of different ways to go at this, which we don't want to be dictating that, because we don't think there's a one-size-fits-all. But what we want are managers actively thinking about when they make housing investments, in particular, how they align with sort of anti-displacement efforts that are going on in a lot of cities. David, anything you
yeah, I think Aaron said that very well. Philosophically, this program is about economic development, but economic development does not mean gentrification or taking neighborhoods and communities and bringing in a more affluent and different population than the people that were there for many, many years previously. So knowing how to do community economic development in a way that functions and is respectful of the community that's already in place is part of our interpretation of how to do opportunity zone investing. As Kimberlee said earlier, it's not written into the law. Maybe it was intent, maybe it wasn't intent, but there's no reason not to do it in a way that is respectful of people and communities that are in place already.
Okay, great, thank you. So our next question here is about the fact that both fund strategies have at least a focus in some part on business investments. And so the person's just asking if there was a particular intent from Kresge to focus on business investments as we were selecting which fund managers to work with.
Kim, did you want to take that or you want me to?
Go ahead, Aaron, that's fine.
Okay. So, I would say that I don't know that I would say that we are focused on operating businesses. Of course, as I said, our work with CCM will have a lot of real estate touching to it. And so what is an operating business from a real estate perspective is a little bit of a minutiae, but I do want to point to sort of legislative history of this thing, right? Where the entire justification was really about the lack of, the problem with accessing capital, particularly growth equity for small to medium-sized businesses in the census tracts, and that the constriction of that kind of risk capital was really leading to a lot of economic mobility challenges or lack of economic mobility for folks. And there's a huge comparison down about, the Bay Area and sort of Austin, right, in New York, and the concentration of venture and private equity in those places, and that being where you see a lot of job growth, particularly high-end wage growth, in those markets, and the correlation between access to capital and those wage growth centers being a huge part of why this thing was enacted to begin with. I think let's not kid ourselves, right? We all know that the big focus of this thing right now is on real estate. I think that is in part because of the way the first tranche of regulations came out compared to the second, which heavily advantaged real estate, and also because this was built off of a real estate designation, right? A census tract designation. Real estate doesn't move, and so from a compliance perspective, up until so arguably say it is easier to do real estate-based investing because you don't have necessarily the same concerns about following the compliance requirements about locating an opportunity zone. Now, I do think the second round of regulations made that dramatically easier, but the growth in real estate is more predictable but muted. The economics in private equity and, of course, venture provide a much larger capital gain return, sort of on a class by class, peer by peer group. And so it was not a focus for us to get into private equity, but the table was set to address those issues. And we think we've got exposure to both. So that's my answer.
Okay, great, thank you. Our next question is, how do opportunity zone rules allow you to avoid depreciation recapture? What is the proper structure?
Sure. Jonathan here. I'll be happy to jump in on that one. And Julia, that might be a longer conversation to have offline too, but I'll give a quick version. So generally, we're looking at assets that could be either Section 1245 assets, like solar farms and capital equipment, things like that are specifically used for a business purpose. And then Section 1250s, which would be like a building. And in Section 1250 is a little bit easier to explain. So let's do that one first. You own a building for 10 years, it depreciates over time. When you sell it, by virtue of being in an opportunity zone fund, what happens when you sell anything in an opportunity zone fund qualified is that your cost basis goes up to the selling price. And that's the reason that you have no recognition of long-term gains. That's generic for any normal asset. So because your depreciation causes your basis to go down over time, that kind of doesn't matter on the way back up because your cost basis steps back up to the selling price. So you kind of get to have your cake and eat it too. You get the benefits of the depreciation on the way down, but you don't get hit on the way up the bar. As well. For Section 1245 assets, it's a little bit more complicated because the recapture is classified as ordinary income as opposed to cap gains. So in this situation, there was a clarification that came out in the IRS reg in April that said that you'd be exempted from Section 751 at the partnership level. So the way to do that is to pledge your Opportunity Zone Fund interests into a feeder co or holdco. I'm sorry if that was a lot of inside baseball talk there, but I wanted to point across. And it has to be done correctly. This is not a blanket exemption within the Opportunity Zone legislation. It's for specific funds with a specific type of structure, of which we are one, but probably not the only one, that will be able to use this depreciation benefit. And Julia, just since I'm on your questions, I saw the second question below that on community benefit of solar fields. Almost never are we doing a solar field in the middle of nowhere just to feed energy for the grid. These are generally tied up with industrial parks or industrial businesses that we will own and operate. So the key is to pull together the source of alternative energy, the PPA off-taker, the means. Another way of answering the question is to ask another question. How do you get someone to move their successful, vibrant business into an opportunity zone? Well, if I can offer you savings on your electricity, savings on your rent, and the benefit share and PTC and ITC solar benefits on top of all the OZ benefits that we already know about, that could be a very compelling case to get a company to move in there.
Okay, great. And Jonathan, just FYI, we're having slight trouble hearing you. If you can just try to keep your mouth close to wherever your microphone is.
Will do. Sorry about that.
There is a question about whether the deal documents will be made public. The covenant, an example covenant term sheet between Kresge and the firms is actually available on our website in our library. Whether or not that's the question, or if you're talking about the actual documents between firms and their investments, I think that's TBD. Another question here is, what are the targeted returns to the other investors in each of these funds?
Not sure. This is David again. I'm not sure what you mean by other investors. I'm not sure that the compliance setup for this webinar is really encouraging us. I think it's kind of discouraging us to talk about returns, but I know our we expect to be competitive with financial returns before the tax benefit. And then obviously if we're successful in achieving the 10-year capital gains forgiveness, the after-tax benefit to our investors would be that much better.
I would just say ditto for Paris. I think you did very well, David.
Okay.
Both of our firms are in regulated industries, so.
Hey, Chris, can I jump in on this? I think another way to answer this, in which we get this question a lot from folks who are sort of looking to find out, like, this is the thing that I want to do in my community. Can I use this money to do it? The answer is almost always yes. You absolutely can do it. But that is not the right question. The question is, will it attract investor capital in relation to what the other offerings are in the marketplace? And because the benefit is ubiquitous, right? It is the same tax benefit for an investor in New York City, in Detroit, in rural Montana, in California, right? It's the same benefit no matter where you go. We, at least I will speak for myself, and I love my panelists to correct me, I have seen very little evidence that any capital, any scalable capital is looking to trade the tax benefit for a lower before tax yield. So basically, like, bottom line, is this a source for subsidy, like new markets or local housing tax credits or sorts, et cetera? I think the answer today is likely no, that it is not a source of meaningful subsidy to projects at this time. Now, I do think that will play out differently in individual markets where there are socially motivated investors. But I don't think either of our funds would consider themselves to be a meaningful source of subsidy to projects in the way that we would traditionally think about it, but I am happy to be corrected.
I mean, what you said is correct from the equity point of view, but I think the existence and presence of impact-oriented debt or debt equivalents is going to go a long way towards lowering the overall cost of business and operations for certain types of high-impact qualified opportunity zone businesses. And so the investor focus, quite rightly, is on equity and the returns to the equity. But if fund managers like us on this call and then others out there in the space are able to bring in non-traditional debt along with the traditional debt that's going to be present no matter what, it will lower the overall cost. And I don't like the term subsidy any more than Aaron does, but it will be a way of giving a financial incentive and reward to the more impact-oriented opportunity zone businesses that get funding. And that's really where Kresge's leadership in kind of kicking this off has kind of paved the way, hopefully, for others to follow.
Okay, thank you. I'm going to try to get through as many questions as I can. We have quite a number still in the queue to go. So the next question is about deployment of funds needing to be by the end of this year. And the question is, can all the interested money go out in the next 7 months? Does it exist, I think?
Sure, happy to on that one. This is Jonathan Arctaris. The thing is that money does not need to go out.
Hey, Jonathan, we're not able to hear you. I'm going to try to patch you in myself, Jonathan. Maybe David can take this.
Thank you.
Let me try to answer that, and then Jonathan can correct me because I don't really know what he was going to say, but I'm going to guess. If you want to maximize every tax benefit that is built into the legislation and into the program, there is a 12/31/19, so New Year's Eve of this year, deadline. And certainly we're motivated to have at least one close before that and have investments ready to go on that date. Doesn't mean they have to be done. It means they have to be funded. And the new regs that Jonathan referred to give greater clarity on a more realistic lead-in and build-up time for getting your investments made. If, and we think this is highly likely, there are closings and investments that are made after December 31st of this year, the other benefits are still available. And of course, the main benefit, the icing on the cake, which is the 10-year capital gains forgiveness, is very much still in place. It would just be in 2030 instead of 2029.
Great, thank you. Question about when we talk about leveraging the guarantees, are you thinking all of that will be in capital gains investments from investors?
This is Jonathan. Hopefully the audio is cooperating with me a little bit better here. The 100% of our LP capital will be from investors who had gains within the last 180 days. In addition, in the fund, we intend to include 1/2 turn of bank leverage. And this serves a number of purposes. On one hand, it functions kind of like a capital call line of credit. On the other hand, it helps to adjust for variances between, let's say we've got one investor who had an IPO on January 1st and he needs to put all of his money in by June 30th. You've got another investor who realizes lumpy long-term capital gains forecasted over the next 24 months. You can actually marry the two investors together in a single fund with the benefit of that leverage. And just going back to my favorite topic of depreciation recapture, if you need to have basis in the partnership in order to allocate out benefits from depreciation. One way of establishing basis in a new fund is with that leverage. So the goal here is not to lever up our returns. The debt really becomes a tool for accomplishing a number of tax logistics and timing logistics around the movement of capital in these situations.
Okay, great. Thank you, Jonathan. A question about more detail around transparency. If there's a little more we can say about the transparency that we're expecting in these funds and how they're operating in community.
So Community Capital Management publishes an annual impact report that collapses all of our client investments into one report on what we've done as a firm. We'll be using that same proprietary database and protocols for reporting on our Opportunity Zone Fund. And then the additional impact metric that we're very excited about, which was referenced earlier in the webinar, is more granular detail on types of jobs created, quality of jobs created, and because this is a 10-year program, we'll have the ability to monitor job and hopefully job growth over the life of the program.
Great, and there was actually a question about job creation component and whether that was a part of the project goals. So maybe you can just segue into that. It sounds like there is at least an intention for job creation, but is there a specific goal?
Well, this is for community capital. There's not a specific goal because the employment component of the businesses we're investing in is going to differ by industry, and some are urban and some are rural. But as a philosophical commitment and point of view, job creation is a big part of the work that we're trying to do.
Great.
And this is Jonathan for Arctaris. I'd just add to David's point, job creation is really our core. That's what we're good at. And in our Kresge agreement, we do have a provision for creating net living wage jobs. This is not articulated as, oh, you're going to create 100 jobs per investment or 1,000 jobs per program. It's not defined like that, but it is specific and measurable in its terms.
Great. Okay, a question about anti-displacement and why there isn't a focus on single-family homes and anti-displacement. Someone can answer that.
Sorry.
I'll try to answer that.
Okay.
David, you can always jump in if you like. I'm trying to deflect. So, I mean, my answer is, this is what we have included as a covenant, and my comments are not excluding single-family homes. So I think to the extent that a fund wanted to invest in that space, I think the covenant would apply. My intuition tells me that there will be limited opportunities to invest in single-family homes, with some notable exception, just based on the scale of capital and the way that you would sort of generate the gain, so that the single-family home investing will be more challenging than like traditional higher density multifamily. But David, I of course would like to be corrected.
No, I think you're right there. The only potential exception that we've seen are sort of planned communities that are mixed use, that may have multifamily and single family components, but it's unclear at this juncture whether the single family would be part of the actual OZ business that would be getting funded.
This is Kimberlee, and I would just arc up one point on the covenants and the level of specificity. The covenants are obviously intended to be enforceable and specific, but we also needed to make them something that the fund managers could easily execute on. given that they are competing in the market with other managers who don't have such restrictions. So, I think the call out about single family is, certainly reasonable, but we were really intending to kind of do an unphilanthropic act, which is really not to handcuff the managers, but to give them enough room to execute their business while still delivering a measurable set of social impacts that, again, in the future, somebody can evaluate for the efficacy of the program.
Thanks, Kimberlee. And another question on the covenants. And is there anything that's defined to retain affordability after a project exit, specifically in the affordable housing context?
A project ends in year 10?
I think it's whenever a project would exit.
Yeah. So
yeah.
That's a great question, and it's very much, at least for what we're seeing so far, a TBD sort of a thing. Obviously, we would hope that whoever ends up as the continued owner of properties after, and just quick review for folks if they don't know, the assumption, at least the one we're making, we think most people are, that is that on the 10-year anniversary of your close, if all has gone well, even though your LP investors love you and love the work that you're doing, they're going to exit. No hard feelings, but that's where they're going to get the benefit of the capital gains avoidance. So in crafting year 10 exit strategies, the most important thing from a fund architecture point of view is to make sure there's a credible way to get the OZ fund out of the OZ business to fund the anticipated redemption from the clients, from the LPs. That creates some very interesting kind of lack of voice and lack of control for the ongoing successor year 10 plus 1 day owner and manager. Certainly our hope is that they'll be enlightened and progressive enough in their approach, and it'll have been working well as currently for a decade as it's constituted under the OZ program. Not clear there's a way to compel, mandate, or require that.
Thank you.
If people are familiar with year 15 issues over in LIHTC world, it's a little bit of deja vu all over again.
So we are about at time here. There is 3 questions left, or a few more questions left. One is about moving existing businesses into an OZ and just asking about the complications in doing so.
Sure. I mean, this is Jonathan. I'll give an example. I mean, we're in the middle of a deal right now, buying a division of a tier 1 automotive parts manufacturing company. They've got 200 employees, and their corporate parent wants to shut them down. So there's an opportunity to buy them and keep those jobs alive and grow the company. And I think there's a valid standalone investment case for doing this with or without the opportunity zone benefits. So we buy the company. We need to find them a new home right away. We're not getting the property with the acquisition. Situation like this, we need a very large factory. One option would be we could buy a building and move them into the building. The other option is ground up development. Because we need to move quickly on this, we probably move them into an existing building. Situation like that, yeah. I mean, moving a factory, it takes time. You've got to package up the equipment. You've got to line out the production lines. It's work. But these are the kinds of things that are done in 3 weeks. It's not 3 years. There's a cost to moving companies. But in this case, it's our choice to move the operating business and all of the capital equipment and all of the people into an opportunity zone, because we think the company will be stronger as a result of it. They will be more resilient. It's more likely that they will survive 10 years. And ultimately, if they're more profitable, they will create more jobs. So we're trying to put the company in the best neighborhood where it can thrive as a business. And moving it for 3 weeks is not too terrible of a cost.
Thank you. So we are over time at this point. I'm going to close us up with one final question. Just a reminder, we will be sharing out the recording. And if there's any other questions, you can send them our way in the email provided. But just to close us, the question here about criticism that the opportunity zones might create more opportunity for investors and syndicators than distressed communities. Kimberlee, I don't know if you want to speak to that, because I think that is really why Kresge moved into this space, was to try to show that doesn't have to be the case. So.
I think that is certainly a risk of this incentive, because, as we've mentioned several times, there are not any standards for social impact. I will, mention that the Urban Institute did a study of the tracts that were selected, and overall found them to be more distressed, which I think, is a good indication that they were thoughtfully chosen. But what the space really needs is it needs experienced managers who have worked in low-income communities and understand that it is often not a singular investment, but that investments are often mutually reinforcing, and who are really trying to ensure that they're making the right investment for a community. This has now become somewhat of an infamous example, but I think we would argue that the self-storage facility that was recently funded with this incentive maybe is not the first thing that a low-income community needs. So yes, we think that there is risk of extractive investments being made. We're also optimistic that perhaps through the leadership of Kresge and the leadership of the managers on the phone today, and by the establishment of these covenants, that both a combination of investor action and public policy could really help this policy, which has real potential, really fully optimized for the communities it's intended to serve.
Thank you, Kimberlee, and thank you to all of our speakers and to all of our participants for joining us. We appreciate it, and we will share out the slides and the full presentation as soon as we can. And with that, we are going to be logging off. So thank you.
Thank you.